Why are commodities a tangible hedge against currency devaluation? Imagine holding a treasure chest that keeps its worth even when the value of your money drops. That's what commodities can do for your investments. When a country's currency loses value, it often causes prices to rise locally. But commodities like gold, oil, and agricultural products are priced on global markets, usually in stable currencies like the United States dollar. So, when your local currency weakens, the price of these commodities in your currency tends to go up. This means you can actually preserve or even increase your purchasing power by holding commodities. Think about gold, for example. It has been used as a store of value for thousands of years. When inflation or currency devaluation happens, gold prices often rise because investors see it as a safe place to keep their wealth. Oil and metals also follow similar patterns. If your currency becomes weaker, it takes more of that currency to buy the same amount of these raw materials. So, your investment in commodities can act as a shield, protecting your wealth from losing its value. From a strategy point of view, adding commodities to your portfolio gives you diversification. This means your overall risk drops because commodities don't always move in the same direction as stocks or bonds. They are physical assets, so they are less affected by policies like printing more money or inflation that can weaken currencies. When a country prints too much money, it can cause inflation and devalue the currency, but commodities tend to keep pace or even outpace inflation. Many commodities have limited supplies or production limits. For example, gold is finite, and oil production is controlled by global agreements. These limits help support their value, especially when currencies are weak. Some commodities like gold are also seen as safe havens during economic crises or currency problems. Investors turn to gold because it has a long history of holding its value when currencies falter. Investors can buy commodities directly, through futures contracts, or exchange-traded funds that focus on commodities. These options make it easier to include commodities in a diversified investment plan. When local currencies devalue, commodity prices in that currency tend to rise, which benefits investors holding those assets. Another point is that countries that produce and export commodities often see their revenues increase when their local currency drops. Because their goods become cheaper for foreign buyers, their exports grow, which can push commodity prices higher. This dynamic makes commodities a practical hedge against currency devaluation. Overall, commodities are tangible assets that can help protect your wealth from the risks of currency devaluation. They provide a real, physical form of value that tends to hold up or grow when money loses its buying power. Including commodities in your investment approach can be a smart way to balance your risk and keep your wealth safe during uncertain economic times.